While the entire investment world rushes into artificial intelligence stocks, treating them as the safest bet since the internet itself, a pattern is emerging that should make every investor pause. Not because AI won't change the world, it almost certainly will, but because the gap between that transformation and today's valuations may be reaching dangerous levels. This isn't a story about technology failing, it's a story about economics catching up with excitement, and history teaches us one thing: when these two forces collide, the outcome is rarely gentle. Let's rewind to 1840s Britain. Railway Mania had taken over the nation. Everyone, from aristocrats to factory workers, was pouring money into railway companies. The technology was revolutionary. It changed transportation forever. But valuations told a very different story. Companies were priced at 50, 60, even 100 times their actual revenue. Investors weren't buying based on current profits. They were buying based on the assumption that every railway would connect every town, that demand would be endless, and that competition didn't exist. Then reality struck. By 1850, most railway companies had collapsed. The ones that survived spent decades paying off the debts from those boom years. The technology succeeded, the bubble did not. Fast forward to March 2000, the dot-com bubble reached its peak. Companies with little or no revenue were valued in the billions. Names like Pets.com and Webvan promised to revolutionize everything from pet food delivery to grocery shopping. The internet itself was revolutionary, but assumptions that every internet company would dominate massive markets, that customer acquisition costs didn't matter, and that profits could wait forever proved catastrophic. When the crash came, $5 trillion in market value vanished. NASDAQ took 15 years to recover. Again, the technology succeeded, the bubble did not. Now, let's examine artificial intelligence in early 2026. The parallels aren't perfect, they never are, but the patterns are unmistakable. Start with valuations. Research from multiple financial firms shows that AI companies are trading at revenue multiples between 20 and 50 times annual revenue, the median range. Some outliers go much higher. OpenAI hit a valuation of $500 billion in late 2025 against projected annual revenue of around $12 billion, a 70 times multiple. Anthropic reached $183 billion, with revenue projections implying multiples above 40. Perplexity, a smaller AI search company, trades around 90 times revenue. These aren't profitable companies. OpenAI, despite its dominant position, is projected to remain unprofitable through 2030, with some estimates showing a funding shortfall exceeding $200 billion. Its annual cloud computing costs alone, around $60 billion, dwarf its revenue. Compare that to traditional software companies. As of late 2025, established SaaS businesses traded around 6 to 7 times revenue. The AI premium is real. The question isn't whether AI deserves a premium, it probably does. The real question is whether today's valuations are pricing in reality or just imagination. A few percentage points here, a little time saved there. At first glance, it sounds promising, but the bigger picture tells a different story. Research from the Penn Wharton budget model projects that I will boost productivity growth by less than 1/10 of a percentage point in 2025, rising to about 0.2% by the early 2030s, before fading again. That's not nothing, but it's hardly the revolutionary leap that today's valuations seem to assume. Take software development as an example. Early reports from companies selling AI coding tools claimed productivity gains of 20 to 55%. Headlines made it sound incredible, but independent research tells a more complicated story. A study from a nonprofit research organization found that while experienced developers believed AI made them 20% faster, objective tests showed they were actually 19% slower. Data from developer analytics firm GetCol shows engineers producing roughly 10% more code since 2022, likely with AI assistance, but the same data reveals sharp declines in code quality metrics. More code doesn't mean better code. Stanford research from late 2025 found that employment for entry-level software developers, aged 22 to 25, dropped nearly 20% between 2022 and 2025. AI is impacting the job market, but it's still unclear whether it actually delivers long-term productivity gains for the companies investing billions into it. Meanwhile, compute costs keep rising. OpenAI alone spends over $5 billion annually on cloud infrastructure, compared to revenue of around $4.9 billion. Unit economics, the cost of delivering a service versus what customers pay, remain challenging for many AI applications. This brings us to the third warning signal: energy and infrastructure limits. AI data centers consume enormous amounts of electricity. Not just a little extra, think the equivalent of small cities. Some proposed AI facilities are requesting over 5 gigawatts of power, exceeding peak loads for entire metropolitan areas. PJM Interconnection, the largest U.S. grid operator in the U.S., serving over 65 million people across 13 states, projects it will be 6 gigawatts short of its reliability requirements by 2027. Joe Bing, president of Independent Market Monitor, warned in early 2026, the grid is at a crisis stage. Those are his words, crisis stage. The problem isn't just total capacity, it's the speed of deployment. An AI data center can be built in roughly 3 years, but the demand is exploding far faster than the infrastructure can keep up with. The real question now is, does paying a 7 to 10 times premium over proven business models even make economic sense, especially when those proven companies are already profitable? Individual company valuations only tell part of the story. Let's zoom out to the infrastructure layer. This is where the scale becomes truly staggering. The 5 largest hyperscalers, Amazon, Microsoft, Google, Meta, and Oracle, are projected to spend over $600 billion on infrastructure in 2026 alone. That's a 36% increase from 2025. Roughly 75% of that, about $450 billion, is dedicated to AI-specific infrastructure. GPS, data centers, networking equipment, cooling systems. Goldman Sachs projects that total hyperscaler capital expenditure from 2025 to 2027 will reach $1.15 trillion, more than double what was spent in the previous 3-year period. Here's where it gets really interesting. These companies are now spending between 45% and 57% of their revenue on capital expenditure. For context, that level of capital intensity is usually only seen in utility companies or heavy industry, not software businesses. This is driving a fundamental shift in how the build-out is funded. In 2025 alone, the big tech companies raised $108 billion in debt to fuel expansion. Projections suggest the tech sector may need to issue $1.5 trillion in new debt over the next few years. This isn't how tech usually works. Historically, growth was funded through cash flow and equity. The move to debt financing on this scale is new and potentially fragile. The assumption behind all this spending seems simple. AI will deliver massive returns, businesses will pay premium prices for AI services, productivity will skyrocket, entirely new markets will emerge, the infrastructure will more than pay for itself. But let's take a closer look at that assumption, because this is where cracks begin to appear. Corporate AI adoption numbers look impressive. A PwC survey found that 79% of companies are using AI in some form. But adoption does not equal value creation. When executives are asked about actual productivity gains, the answers tell a different story. A late 2025 survey found that nearly 90% of executives reported that AI had no measurable impact on productivity at their firms over the previous 3 years. That's not a typo, 90%. Despite years of AI investment, measurable productivity gains were nearly non-existent. Some companies reported small efficiency improvements, but these were often modest at best. Building a large-scale power plant or transmission infrastructure takes 5 to 7 years. That mismatch is creating bottlenecks that could physically limit AI deployment, no matter how much demand or investment exists. And there's now a political dimension. Residential electricity prices rose about 5% in 2025 and are expected to rise another 4% in 2026. Analysis from Monitoring Analytics attributes $23 billion in extra costs to data centers, which then flow through to consumer bills. The backlash is real and bipartisan. Senator Bernie Sanders has called for a moratorium on new data center construction. Florida Governor Ron DeSantis, from the opposite political side, has expressed similar concerns. When both the left and right find common ground on infrastructure, it usually signals that public opposition is broad and growing. With midterm elections coming in November 2026, this isn't just an economic issue anymore, it's political. Local communities are pushing back as well. In Palm Beach County, residents opposed a proposed data center, citing noise, water use, pollution, and higher utility bills. One local resident said bluntly, "No good comes of having an AI data center near you." Grassroots opposition like this makes permitting and construction increasingly difficult. Now let's look at the composition of the AI industry itself, which exposes another structural weakness. Industry analysis suggests roughly 80% of companies calling themselves AI firms are essentially reselling access to a few foundation models, mainly OpenAI's GPT, Anthropic's Claude, or similar platforms. These companies often just build thin application layers on top of someone else's technology. That's not inherently a problem if their applications create real value, but many face tough economics. Customer acquisition costs often exceed lifetime customer value. They compete on features that can be quickly copied, and they rely on APIs whose pricing they don't control. When OpenAI or Anthropic changes pricing, adds competing features, or modifies terms of service, these smaller companies have little leverage. Their competitive moat is often minimal. This creates a pyramid structure. At the top, a few foundation model companies backed by massive capital and hyperscaler partnerships. In the middle, thousands of application companies, many of which may not survive sustained competition. At the bottom, users still figuring out which AI use cases are actually worth the cost. Venture capital funding patterns only reinforce this concern. Money is flowing in, but the structure itself may be fragile. In 2025, AI startups grabbed an enormous share of total venture capital. Some estimates suggest more than 50% of all VC funding went into AI-related companies. That's not diversification, it's heavy concentration. History shows that when VC money piles into a single sector like this, it often signals the late stage of a cycle. The best opportunities are likely already funded. New companies are mostly filling niches, making incremental improvements, or copying existing approaches with slight variations. Capital efficiency is dropping. Later stage AI companies often require multiple billions just to scale. This is very different from the lean startup model that defined earlier tech waves. When billions are needed just to compete, market entry is limited to those who can access that capital, and exit options narrow significantly. Regulatory clouds are gathering. The European Union's AI Act introduces complex compliance rules affecting US companies. While full federal regulation isn't here yet, multiple bills are circulating, state-level rules are emerging, and bipartisan concerns over AI and election interference are pushing for governance. These regulations may be necessary, but they also create uncertainty, increase operating costs, and can catch companies off guard if products were designed assuming a permissionless environment. Then there's the talent crunch. AI engineer salaries have reached unsustainable levels. Compensation for experienced machine learning engineers at top firms can exceed $500,000 to $1 million per year, roughly 3 times what was sustainable in prior tech cycles. High salaries make sense when capital is abundant and companies are fighting for scarce talent, but they become unsustainable when revenue growth slows, funding tightens, or investors demand profitability over growth. Eventually, salary compression happens, and when it does, it's disruptive. Insider selling offers another warning. Throughout 2025, insiders at major AI companies sold elevated levels of stock, another signal that executives may be hedging against future uncertainty. When founders, executives, and early employees sell significant stakes, it doesn't automatically signal trouble. They might be diversifying, funding other ventures, or securing their financial future. But when insider selling is high while public statements are full of boundless optimism, it creates a disconnect worth noting. Step back and look at the full picture. Valuations assume extraordinary growth. Infrastructure spending is running ahead of actual revenue. Productivity gains remain modest despite widespread adoption. Energy constraints could physically limit deployment. Most AI applications sit on a thin layer atop a concentrated foundation layer. Regulatory uncertainty looms. Talent costs are unsustainably high. Bipartisan political opposition is emerging over infrastructure impacts. Alone, none of these factors proves a bubble exists. Together, they suggest the AI industry is entering a period where expectations and economics must reconcile. Here's the nuance. This doesn't mean AI will fail. Railways failed as companies, but transformed transportation. Dotcom companies failed, but the internet changed everything. AI will almost certainly transform knowledge, work, automation, decision-making, and countless areas we haven't imagined yet. The question isn't whether AI succeeds, it's whether today's valuations accurately reflect the timeline, adoption curve, competitive dynamics, and unit economics of that success. Will investors buying today at 40 to 70 times revenue see returns that justify those valuations? Will the infrastructure being built generate sufficient revenue before cheaper alternatives appear, or efficiency gains make parts of it obsolete? If AI adoption accelerates faster than expected, killer apps emerge and productivity gains materialize at scale in 12 to 18 months. Today's valuations could be justified. Markets sometimes price in transformational change before it's fully visible, but if adoption is gradual, productivity gains remain incremental, energy constraints bind, regulatory costs rise, or competition erodes margins, a reckoning becomes likely, not in 5 years, but much sooner, probably within 18 to 24 months. Specific catalysts could trigger this timeline. Infrastructure debt issued in 2025 starts demanding measurable returns. Midterm elections in November 2026 may put political pressure on data center expansion. Companies that raised massive funding in 2024 to 2025 will need to prove progress toward profitability. Public markets will demand evidence that high capital spending pays off. Energy grid constraints could impose physical limits regardless of financial appetite. The smartest analysts aren't dismissing AI, they're asking hard questions about valuations, timelines, and sustainability. They distinguish between companies with real competitive advantages and those reselling commodity services. They watch productivity, not just adoption. They monitor debt, not just revenue growth. The lesson from Railway Mania in the dot-com bubble isn't to avoid transformational technology, it's to be extremely careful about paying for transformation before it materializes. Railways succeeded, railway investors largely did not. The internet succeeded, most investors did not. AI will succeed. Whether AI investors succeed depends entirely on the price they pay today for tomorrow's revolution. Right now, looking at valuations, spending patterns, productivity data, infrastructure limits, and regulatory pressure, that price looks stretched. The rubber band is pulled tight. The question isn't if it will snap, it's when and how violently.